So today in this video we will just talk about how valuation works in investment banking. So valuation is the process of estimating what a company is worth. Investment bankers use it to advise clients on M&A, IPO, fundraising, and strategic strategic decisions. So there are four steps we follow for the overall valuation purpose. So in first step we do to understand about the company. So the sub points in this: first we understand the business model, the product and services it provides, and how it generates revenue. The second one is industry and competitors. Third one is revenue and profit trends. Fourth one, growth opportunities. And fifth one is risk like inflation and interest rate risks and government policies. The second step we follow: collecting financial information. So financial information like income statement, balance sheet, cash flow statement, management guidance, and industry data. Differently, so we perform through these uh, financial information. Like from income statement we do calculate net profit margin, EBITDA margin, and from balance sheet we calculate debt to asset and debt to equity ratio, or debt to EBITDA ratio. And the third step is very critical, that is applying valuation method. Mainly we do have three valuation method, that is discounted cash flow method, the second one is trading comparables, and third one is transaction comparables. So discounted cash flow method in this we first forecast the future cash flows, then discount them to today's value using the WACC. WACC is used as discount rate. Add the terminal value, the present value of the terminal value added over here. This gives the enterprise value. And in trading comparables, compare the company with similar public listed companies. Use valuation multiples such as EV by EBITDA, EV by revenue, and PE multiple, price to earning ratio. In third method, we do have transaction comparables, in which we do compare with similar companies that were acquired. Acquisition price often include a control premium, so the valuation in transaction comparable can be higher due to the control premium. And after doing this we arrive at enterprise value. For example, if DCF valuation comes out to be 980 crore, trading comparable comes out to be 1020 crore, and transaction comparable comes out to be 1100 crore, then the banker may conclude that the company's enterprise value is around 1000 to 1100 range. Right, so now we will discuss to convert enterprise value to equity value to calculate the share price. Right, so equity value equal to enterprise value minus net debt. So for example, the enterprise value comes out to be 1000 crore, that to be 250 crore, and cash to be 50 crore. So debt minus cash, that is 250 minus 50, comes out to be 200 as net debt, and active equity value, that is enterprise value minus net debt. So over here 1000 minus 200 comes out to be 800 crore. So how we calculate the share price? Let's suppose if there are 80 crore shares outstanding, and the share price, we calculate equity values divided by our share outstanding. So 800 was our equity value divided by number of shares outstanding, that is 80 crore. So the share value comes out to be 10 rupees per share. So how investment bankers use this valuation, or the valuation range we calculated as 1000 to 1100. How investment banker use it? They use it for merger and acquisition purpose, for IPO pricing, before launching to the investment bank, to the financial market or to the stock exchange before the listing. IPO pricing also decided through this valuation. In fundraising or fairness of opinion or for strategy decision making, like for investment. So these are the five uses investment bankers do the for these valuation we come out with. So hope you understood the valuation method and used in how it is used in investment banking. So if you understood, please like, subscribe and share the video. Thanks for watching. Okay. अरे यार